Okay, so good evening once again. Yes, in our last class, which is of course the lecture day number 1, we started with marginal and absorption costing, and then of course all the underlying principle and concepts of operating statement were discussed, and today we are supposed to go in straight to solving illustrations so that we can complete the topic and then move to the next one. However, for the benefit of those that are just joining for the first time, I will take my time for the next 5 minutes or thereabout to explain what we did last time. Now, we said that part of the things we discussed last time was that operating statements, which is of course the same thing as income statements, is a statement that is used to present the operating results or performance of an organization at a particular period. And then basically we have two methods of presenting operating statements, including marginal costing method, then 2, absorption costing method. And we said that marginal costing concept is a technique that charge the total variable cost of production, including direct material, direct labor, direct expenses, and variable parts of production to the unit cost of a product. Meaning that whenever a company wants to determine the unit cost of a product, the company will only consider those costs that are directly related to the production of that product, which are the 4 elements I just mentioned. That is direct material, direct labor, direct expenses, and variable overhead. As far as marginal costing approach is concerned, we said that it's an accounting system. I mean, it is an accounting system in which the period costs incurred are written off fully from the aggregate contribution. And we also said that last week, I provided you with some features or some key points that you need to know as far as operating or as far as marginal costing technique is concerned. These elements or these features that I mentioned, they are very key in the presentation of in the preparation of the income statement using marginal costing approach. The first thing I mentioned was that opening and closing stocks are valued at total variable cost per unit. That's number 1 thing that we discussed. Then 2, we said that marginal costing approach uses gross profits, unlike absorption costing approach that considers a gross, uses the contribution, unlike the absorption costing approach that recognizes gross profit. So that's number 2. Not only that, we also said that under marginal costing approach, fixed production overhead is written off fully from the aggregate contribution. Okay, fixed production overhead is written off fully from the aggregate contribution because fixed production overhead is not part of production cost under marginal costing approach. Not only that, we also mentioned in the class that absorption costing approach does not recognize overhead absorption. Marginal costing approach does not recognize overhead absorption. Okay, so these are some of the things that we discussed under marginal costing approach. And we also said that this marginal costing approach is a technique that is designed principally to aid managerial decision. What this simply means is that when it comes to decision making, you need the technique of marginal costing in order to support management in making that managerial decision, so that management can be able to focus on the critical success factors of the organization. Now, of course, later on that day, I also presented you with the formats that you are going to use in the preparation of the income statement using marginal costing approach. All of this, I explain it. So when we're about to do illustration today, I will also do the same thing for the benefits of those that are just joining. Then we move to absorption costing approach. And we said that The absorption costing approach is a concept that charges the total cost of production, including both variable and fixed, to the unit cost of a product. That is, when you want to determine the unit cost of a product, you're only going to consider all those costs that are variable, including direct material, direct labor, direct expenses, variable overhead, plus fixed production overhead. Those are the costs that will form the production cost under absorption costing method. And we said that absorption costing method is a technique that relies heavily, okay, on the generally accepted accounting principles for external reporting purposes. All right. Then thereafter, we discussed the key features that you need to take into consideration when you are preparing the income statements using absorption costing approach. The first thing that we discussed under absorption was that opening and closing stocks are valued at total cost per unit. Okay, so both variable and fixed production overhead, everything, including direct material, direct labor, direct expenses, will be added together to get the total cost per unit. So once you get the total cost per unit, then you need to multiply with the opening or the closing stock to get the value. Then we also said that under absorption costing approach, fixed production overhead is part of production cost. Okay, and in this case, which means that the fixed production overhead will vary depending on the activity level. If your activity level increases, then it means that your fixed production overhead will also increase and vice versa. All right. Then we also said that absorption costing approach recognizes overhead absorption. Okay, because under overhead absorption, of course, you compare the budgeted overhead with actual overhead. So to know whether it is under or over, we'll discuss it too as we proceed. Then not only that, we also said that absorption costing approach uses gross profits, unlike marginal costing approach that considers a contribution. So these are the things that we discuss as far as absorption costing approach is concerned. Then we now talked about the overhead assumption. I mentioned to you that overhead assumption, even though it's not in this material, but I said overhead assumption is the same thing as when you talk about overhead. Overhead is simply means indirect cost. All those costs that you incur in a company, all those costs that a company will incur in running the factory, like for example, the rent, the electricity, the utility, its lightning, depreciation of the machinery, and all of that. All those costs are what we call overhead costs, and which is the same thing as indirect cost. So that overheads, the overheads could be variable, it could be fixed. But the bottom line here is that this overhead assumption, we said, is the process of allocating indirect costs, including the rents, the electricity, the depreciation of the machinery, and of course, the heat, the lightning, all those costs that will be incurred in the factory. So the process of allocating them to a product or service is what is called overhead absorption costing. Generally, when the budgeted overhead or output is the same thing as actual overhead or output, it means that the overhead is correctly or appropriately absorbed. Okay? However, there will be some situation whereby the budgeted overhead will be different from actual overhead. So when this happens, so the difference is supposed to be adjusted from the cost of goods sold. Then we now talk about under absorption and the over absorption. We said that under absorption arises when the budgeted output is less than the actual output or actual overhead. So when this happens, the difference should be deducted from the cost of goods sold. Then we now move to over absorption. We said over absorption will occur when the budgeted output is greater than the actual output or actual overhead. So in this situation, the difference should be added to the cost of goods sold. So these are the things then that we discussed last time. In addition to that, we also mentioned the fact that with the result produced using marginal costing approach and the one produced using absorption costing approach will generally produce and will generally result to a conflicting performance. That is, the net profits under marginal costing approach will be different with the net profit under absorption costing method. So when this happens, you need to reconcile the difference and find what is causing the difference. And we said that majorly the difference between the profits or between the operating performance using marginal costing and absorption costing method is because of the stock valuation. This is because marginal costing approach value stocks, both opening and closing, using total variable cost per unit, whereas absorption costing approach value stocks using total cost per unit. Then I now provided you with the format that you are going to use to find as a reconciliation statement to find the difference between the operating performance of the two techniques. So this is where we stopped last week. And from this point, what we need to do now is to solve the illustration. So for all of you, so let me hear from you in case you have any question so far, and then based on what we did last time, so in case you have any question within the next 2 minutes, let's quickly have it before we move into solving questions. Let me know if you have any question for me so far. If not, I'll move straight to calculations. Okay. All right, then. So in the absence of no question for now, let's go to solving question. So let me just scroll down. We are not going to solve more than 2 illustrations because generally question under marginal absorption are usually lengthy to solve, especially when you have more than one period. So yes. So that won't be the only one that will be talking. I want the class to be interactive. So let's somebody read for us. Who is there to read for us? Somebody should volunteer. If not, I will mention one of you to read. Amarachi, you want to read?
Illustration 1.
Okay, yeah, Amarachi.
Fernandez Company Limited. Are we all hearing?
Yes, I can hear you. Go ahead.
Fernandez Company Limited manufactured face towel. The standard unit cost of its production are given below. Direct material 1.6, direct labor 1.50, variable manufacturing overheads 1.2, mixed manufacturing overhead 3, altogether 7.3. At normal operating capacity, 200,000 units of products should be manufactured. Variable selling and administrative expenses amount to 50 kobo per unit, and fixed selling and administrative expenses amount to 75,000 naira a year. Income taxes at 40% of net income before taxes. Production and sales data for year 2008 and 2009 in units. Inventory on hand, January 2008, 28,000. Production for year 2008, 200,000. Sales for year 2008, 160,000. Production for year 2009, 150,000. Sales for year 2009, 180,000. In both years, each towel is sold for 10.5. Required Prepare income statements for the years by A. Assumption costing method. B. Variable costing method. C. Prepare a reconciliation statement to show why there is difference between the results of the two methods.
Thank you very much, Amara. Appreciate. So, whenever you are given a question, the most important thing you need to do is to go straight to the requirements of the question. Go and check what examiner is expected of you before you begin to read the body of the question. In this particular question, you are required to prepare income statements for the years by assumption costing and variable costing method. Not only that, you're also required to prepare the reconciliation statement to show why there is a difference, why there is a difference between the two, between the result of the two methods. So if that is the case, now I want to prepare income statement using assumption. Before you do anything, before you get to this stage, before you get to solving any question, you must understand the underlying concepts in the question. You must you must understand the underlying concepts. You must know how to prepare your income statement. Your starting point is to memorize the format. Once you know the content of the format, the question is over 50% solved, because that is your starting point. If you don't understand the format, if you cannot memorize the format and write it down on your own, then there will be problem. And this topic, marginal and absorption costing, is a self-balancing kind of a question anytime examiner give it out. The reason being that if your reconciliation statement is balanced, is okay, that means what you have done is perfectly good, it's perfectly okay. Once the difference in profit and difference in stock valuation are equal, it means that what you have done is perfectly okay. That means you are guaranteed of 15 or 20 marks in that particular question, no matter how big it is. I repeat, your starting point is the memorization of the format. So you learn it, you close the book, then you write it down on your own so that you can become master of that. So let's solve this question. We want to prepare the income statements using absorption and marginal costing method. So as you can see here, examiner mentioned variable costing method. I told you last week, marginal costing is the same thing as variable costing or direct costing method. Is the same thing. So whatever examiner has used in terms of terminology, you should know that they are the same. All right. Okay, then. So I will switch from this note to the working note so that we can solve the question. Please open to the material with you so that we follow together, because once I switch to the working notes, you won't be seeing this one again. It's the working note that you're going to see. So you can open to the material at your own hand. All right. So I will stop sharing this now. So let me share the material with you. Please, let me know if you can see my screen.
Yeah.
Okay, then.
Yes,
Thank
sir,
you.
we can see your screen.
Thank you. So the first requirement says that we should prepare income statements using absorption
Hello,
cost.
sir.
Yes,
Sorry, sir. Did you send the material before now?
the
I'm not
material.
sure I have it.
So if you are in the group, your colleagues will share again.
Okay.
Yep. Somebody should help her out from the group, reshare the material again. Thank you. All right, then. So the name of this company is Fernandez. So I will then come here. Fernandez Company Limited. Number A, income statements using absorption costing method. Please remember what I told you last week. Don't come here when you are, this is an exam question. You don't do this on the day of your exam by writing ACM. This is not permitted. At least at the first instance, you are supposed to write it out in full. What you are supposed to say is to say absorption costing the method, okay? You can then put in brackets ACM so that going forward, you will be referencing ACM. But at the first instance, you can't just write income statement using ACM. What is the meaning of ACM? You want examiner to be racking his or her brain to get what you are trying to communicate. So that's why it is important. At the first instance, you need to write it out in full, absorption costing method. But for the purpose of this class, I've shortened the description of that. So it is ACM. Then I can then come in and put Naira sign. Okay. Yes. In this question, we have two periods, 2008 and 2009. So that means I'm going to create 4 columns, debit and credit, for both 2008 and 2009. Therefore, I will come here, 2008, then 2009. So, yeah, draw this down, draw this down. Okay. Each of them divided into 2 equal parts. This my line is too straight. I'm not using ruler, you manage it. After all, I'm not an artist, I'm an accountant. Okay. So you have the privilege of using ruler, so I don't have ruler here. Okay then, so you can see, instead of me to come under 2008 and be putting Naira sign, I've already put the Naira sign on top, so that will save time on the day of the exam. So yes, the first item from our table is sales value. So sales or revenue, I would then come as sales. Now, we said that sales is determined as units sold multiplied by selling price per unit. So let's go back to the question. How much is the unit sold? How many units were sold in 2008? In 2008, we are told that, pardon?
160,000.
160,000. And the selling price per unit is 10 naira 50 kobo. Therefore, 160,000 units multiplied by 10.5. What you get?
1,680,000.
Thank you. So because our numbers are in thousands, I'll just come here 1,680,000. So I'm done with sales for 2008. The next item after sales is production cost. If you like, you can say variable production cost, or if you like, just say production cost. Okay, then. The first item under production cost should be opening stock. Opening stock. And we said that, remember, the feature of absorption costing approach. Okay, the feature of absorption costing approach. We said that opening and closing stocks are valued at total cost per unit. So the total cost per unit in the question is 7 naira 30 kobo. When you add up, according to the question, when you add up the cost per unit of 1.6 plus 1.5 plus 1.2 plus 3 naira, that gave 7 naira 30 kobo. That is the cost per, that is total cost per unit. Therefore, here is 7.3. Now that you have the total cost per unit, I need to go back to the question to go and find out if examiner has given me opening stocks in units. So according to the question, we are given inventory on hand January 2008 of 28,000 units. So I need somebody to multiply 28,000 units with 7.3 naira.
204,400 naira.
Thank you. Here is 204.4 because our number are in thousands. Okay, then. So after opening stocks, you need to consider prime cost, which is direct material, direct labor, and direct expenses. Then you now include variable factory overhead and fixed factory overhead. So I will go to the question. It is not compulsory that at all time in a question, examiner will give to you all those line item in the total cost. So whichever one that is given to you is what you are going to use or you are going to calculate for. So I will go back to the question. I will go and check if I have direct material per unit. Yes, in this question, we are given direct material of 1 naira 60 kobo. Therefore, I will then come here, direct material at 1 naira 60 kobo. Let me check again if we have direct labor. Yes, we have direct labor of 1 naira 50 kobo. Direct labor at 1 naira 50 kobo. Let's check if you have direct expenses. There's no direct expenses, but we have variable manufacturing overhead. Okay, so I would then say variable manufacturing overhead at how much is that? 1 naira 20 kobo. Okay, 1 naira 20 kobo. Then in the question, because we are using absorption costing method, you have to consider fixed manufacturing overhead because based on, according to ACM, fixed production overhead is part of production cost in determining the unit cost of a product. So I would then say fixed manufacturing overhead at 3 naira. So at this point, I would then go back to the question to multiply the unit produced, the actual unit produced for that period for 2008. I will multiply the actual unit produced with the cost per unit. So in 2008, how many units were produced?
200,000.
200,000 units were produced. Therefore, I would then say I want to determine direct material cost. So 200,000 units multiplied by 1.6, what you get?
20.
Pardon?
320,000.
320, okay. Then direct labor, 1.5 multiplied by 200,000. Some people can be unnecessarily stubborn. I've told you.
300.
Thank you.
300,000.
Here is 300,000. Then 1.2 multiplied by 200 will give us 240. 3 multiplied by 200 will give us 600. So you add it up. Add all of them. What do you get? One, six, six,
4.4.
4.4. Okay. Thank you. So this 1,664,400 naira is called cost of goods available for sales. Cost of goods available for sales. That's your COGAS. So immediately after COGAS, we need to consider closing stocks. Closing stock. Don't forget, closing stock will be valued at total cost per unit, and total cost per unit is 7 naira 30 kobo. So at this point, we need to go and do calculation for closing stock. Examiner will never give to you closing stock. So you are the one that will determine closing stock yourself. So this page is for it's for absorption costing method. The second page is for marginal. The third page is for reconciliation statement. Then the fourth page will be for the workings. You see the way I'm doing it? This is the way you're supposed to present your work on the day of your exam. You don't start with working on the main solution page of your question paper on your answer booklet. Your working should be the last thing that you are going to write in your answer booklet. The main solution should come first. All right. So I would then say workings. Working number 1, closing stock. Okay. So we have 2 periods, which is 2008, 2009. So when you want to determine closing stock is simply opening stock plus actual production for that year, then less units sold. So I will come here, opening stock. In 2008, opening stock is 28,000 units. Then we are going to add actual production or actual output. Actual units produced in 2008 was 200,000. Add the two together. That gave us 228,000. This is total units available. This is total units available for sales. Okay, let me write that because of space, too tiny. Total units available. Then after this, you need to less sales. So then less units sold. In 2008, how many units were sold? In 2008, 160,000 units were sold. So less 160,000. The difference is 68,000.
68.
Thank you. So this is closing stock. You can call it closing or unsold stock. Closing or unsold stock. That is for 2008. Let's do once and for all, let's do for 2009. Now, when you are moving to the 1st January 2009, the closing stocks in units in 2008 as at December 2008 will become opening stock on 1st January 2009. Therefore, opening stock in 2009 is 68,000. How many units were produced in 2009? 150,000 units. So here is 150,000. Add the two together, 218,000 units. Then how many units were sold in 2009? 180,000 units were sold. Here is 180,000. Therefore, 180,000 minus 218 will give us 38,000. So we have calculated closing stocks in units for both years. So at this point, we need to value the closing stock. Remember, we said that using absorption costing method, closing stock will be valued at total cost per unit. Therefore, I will then come here, valuation. (2008). Under 2008, I will have ACM, absorption costing method. I will also have variable costing method. Variable costing method. So under absorption costing method, you are going to multiply the units with the total cost per unit. So in 2008, closing stock in units is 68,000. 68,000 units. Then you multiply with total cost per unit of 730 kobo. So what you get? What do you get?
496,400.
496.4.
496,400.
Okay, thank you. So let's go to variable costing method. So in that 2008 is the same 68,000 units. But for variable, you are going to multiply with total variable cost per unit. If you go to the table given to where you have the cost per unit, the total cost per unit is 7.30 kobo. If you less fixed manufacturing overhead, what you have left is your variable cost per unit, which is 4.30 kobo.
Yes.
So I would then say 4.30 kobo. So what do you get? 68,000 units. What do you get?
292.4.
292.4. So with this, we have valued the closing stock. Okay. So let's go and post 496.4. 496.4. So I will then come here. 496.4. You are going to less it. Okay. So this is working number 1. Okay. All right. So what's the difference? What do you have? What's the difference? 1664.4 minus 496.4.
1168.
1168. So this 1168 is called cost of sales or cost of goods sold. Okay. So after cost of goods sold, remember my explanation today when I was trying to recap on what we did last week under overhead absorption costing. And I said that overhead absorption costing is the process of allocating indirect costs to a product or service. So when budgeted overhead or actual overhead is the same as when budgeted overhead or output is the same thing as actual overhead or output. It means that that overhead is appropriately absorbed. But if budgeted overhead is different from actual overhead, it means that the difference must be adjusted from the cost of goods sold. So if you are using absorption costing method, immediately after your cost of goods sold, you must consider overhead absorption. So you don't just come in and be putting under or over. You need to first of all go and do your working to know what you are going to have. So if your working shows it is under, then you come and put under. If your working shows it is over, then you come and put over absorbed overhead. So you don't just come and be putting under slash over. No, that's not a good presentation. So let's go and do our working for overhead absorption. So working number 2. Now, we are still coming back to the closing stock for 2009. So let me just give a space for that. 2009 for ACM, for VCM. So I can then go to working number 2 now. For working number 2, we want to determine overhead absorption. Overhead absorption. Okay. Now we have 2008. We also have 2009. Remember, when it comes to overhead assumption, you are comparing budgeted overhead or output with the actual overhead or output. In this question, the examiner did not give to us budgeted overhead. So what we need to do is to, of course, we are given budgeted output, which is the normal capacity. So we are going to compare the budgeted output with the actual output to know whether it is under or over absorption. So once you have the difference, then we now multiply with the fixed overhead absorption rate. So I will then come here, budgets, budgeted output. I will go back to the question. What is the normal operating capacity? According to the question, at normal operating capacity, 200,000 units of products should be manufactured. That is the budgeted output. Okay, that's the budgeted output, 200,000 in 2008 is budgeted. Then actual output or production in 2008, how many units were produced? 200,000. So in this case, it means that the overhead is rightly or appropriately absorbed because what the company intends to produce is what they actually produce. So there is no difference. No difference. So you put a dash. Okay. Now, let's do for 2009 once and for all so that we know that is gone. So in 2009, let me just come here and put difference. So in 2009, the budgeted output still remain as 200,000. How much is what's the actual units produced in 2009?
150.
150,000 units were produced. So I would then come here 150,000. So 200,000 units minus 150,000 units will give us 50,000
50.
units. So in this case, remember my explanation, it will be if the budgeted output is less than the actual output, it means that it is under absorption. Okay, when budgeted output is lower than the actual output, it is under absorption. But if the budgeted output is greater than actual output, it is over absorption. So in this case, this 50,000 units you have here is over absorption. So if it is over absorption, what do? You had the overhead absorbed to the cost of goods sold. So what we have here, the difference.
Sorry, sir, can you say that again?
Okay, I'm coming. Difference equal to over absorption. Because the budgeted output is greater than actual output. Now, who has that question?
It's me, sir.
What's the name?
Great.
Great. Okay. Now, what we are saying is that if the budgeted output is less than the actual output or overhead, the difference is called under absorption. Okay. But if budgeted output is greater than the actual output or overhead, it is called over absorption. So if it is under absorption, you less from the cost of goods sold. But if it is over absorption, you add it to the cost of goods sold. All right. I hope that is clear. So
Okay.
the difference now, which is 50,000. So I would then say over equal to 50,000 units. Of course, you are supposed to multiply the difference. I would then say over, let me just put the formula there. Over, which is equal to difference multiplied by fixed overhead absorption rate. The fixed overhead absorption rate is the same thing as your fixed manufacturing overhead per unit. Okay, so in this case, I would then say 50,000 units multiplied by the fixed overhead assumption rate is 3 naira, which is equal to 150,000 naira. Please, you have to be very careful because we have restricted our number to thousands. This 150,000 naira, we are not going to write 150,000. We are going to write just 150 so that you don't make mistake. We've already rounded your number to 1,000. So I will then go up there. Let's go and make the adjustments. So we are adding to the cost of goods sold. So I would then say over absorption. So which is 150. You add it to the cost of goods sold.
So that should be in 209, not 208.
Which one?
The over and under.
This is for 2009.
Oh, sorry. Thank you. 2009. Thank you. Yeah. This one is 0. Okay. Let me come here. 150. Okay then. So in 2008, there was no overhead assumption because what is budgeted for, it's what is being produced. Therefore, it will remain the 1168 will be deducted from the sales value. So what do you have? 1680 minus 1168. What you get? Yes.
512.
512. So 512 will represent the gross profits. Okay, this is gross profits. After this, the next item for us is to consider all other costs that is not related to production. Immediately after the gross profit, we need to consider non-production costs, whether it is variable or fixed. Any cost that has to do with non-production, that is not related to production, will be considered here. So non-production cost. Yes, go ahead.
Okay, great. Thank you. It's about this, the over and under absorption.
Yeah.
I get it that when, like for that 2009,
Yeah.
because we have our, I get the concept, right? But I'm trying to understand it in layman terms.
Yeah.
Right? When like that 2009, I think we have, what do we have there? Let me go. I think we have over absorption there,
Yeah.
right? When the budgeted is greater than our actual
Yeah.
output. Well, the concept of adding it to the cost of goods sold,
Yeah.
is that not we still trying to exceed, say that the cost of goods sold was high or something? I'm trying to understand why we're adding it.
Yeah, we explained this in details in our last class. The bottom line is that it's a principle that you have to apply. One of the reasons for overhead absorption is seasonal variation. For example, at the beginning of the year, or maybe in the middle of the year, depending on when a company is preparing its budgets, you could have planned for the following year to say this is how much overhead that you are going to incur. This is how many units that you are going to produce in the subsequent year. So, and then you would have planned to say that, for example, I just mentioned seasonal variation. Seasonal variation simply means that there are some certain period in the year that customers do buy more of a company's product. So you cannot predict how customer will react to your product during those periods, because it also depends on the disposable income of the consumer. All right. So if what you budgeted to spend is greater than what you actually spend, of course, you are looking at the times, okay, budget is greater than the actual, then why you wouldn't harden it? But again, you need to consider, in every topic we have principle, there are concepts, the underlying concept of each of them. What is important is the fact that if your budgeted output is lower than the actual, it is under absorption. That under should be should be deducted from the cost of goods sold. However, if the budgeted is greater than the actual, what you need to do is to add it back to the cost of goods sold. All right. So the overhead we are talking about here is those items I mentioned earlier today. When you want to produce in the factory, you are going to need the rent of the space you are using as the factory will be allocated to the product. Not only that, for you to produce, you are going to need water. Okay, you are going to pay all those utility, the electricity, the lighting, and all of that you are going to use to produce the product. Those are the overheads we are talking about. So the actual overhead and what you budgeted to spend, once they are different, that means the adjustments must be made through the cost of goods sold. So all these things, we discussed it in details last time. I'm just trying to recap again. All right. So I also mentioned to you one of the reasons, one of the causes for the overhead absorption is what I just mentioned, seasonal variation. Okay. Yep. So
Thank you.
you are welcome. Yes. Immediately after the gross profits, you need to consider non-production cost. This non-production cost could be variable or fixed, irrespective. Just come under the non-production cost and put the number there. So the first item, you go back to the question. At times, you may have, when you talk about non-production cost, you can have variable selling and distribution expenses or sales commission. Sales commission is not related to production. Selling expenses is not related to production. So any cost that you incur that is not related to production will come under the non-production cost. You can also have fixed selling and distribution expenses. You can have fixed admin expenses. So whatever those costs that are given to you that is not related to production will come under the non-production cost. So let's go back to the question and identify if we are given those kind of a cost. When you look at the paragraph after the first table, we are told that variable selling and admin expenses amount to 50 kobo per unit. So let's go and account for that. So we have variable selling and selling and distribution, selling and admin at 50 kobo, 0.50. So when you talk about variable selling and admin, it means that this variable selling and admin will vary according to the number of units sold. So you now go to the question, how many units were sold in 2008? In 2008, the company sold 160,000. Therefore, 0.5 multiplied by 160,000 will give us 80,000. So here I will put 80. I will go back to the question. If I have other fixed costs that is not related to production, we're also told that fixed selling and admin expenses amount to 75,000 naira a year. So fixed selling and admin, 75,000 naira a year. So I will don't come here 75. So add the two together, that's 155,000. So 155,000 minus 512, what you get? 512 minus 155 equal 357. So here is 357. This 357 is called profits before tax. So immediately after the profit before tax, you need to consider income tax. So you need to consider income tax. Therefore, I will then go in there, income tax. What's income tax given to us? 40%. So 40% of 357. This will give me 357 multiplied by 0.4 equal 142.8. Here is 1 42.8. So I will find the difference. Minus 357 equal 214.2. Here is 214.2. This 214.2 represent the net profit. This is the operating performance or results that we are talking about. This is the operating result or performance we are talking about. So that's that. Let me just remove this to make it look neater, since I'm not using a ruler. So I think it's better this way. Okay, then. Let me adjust this one too. So we are done with 2008. Let's go to 2009 quickly. In 2009,
Hold on, come down a little.
no, you are not writing yet. Let me finish what I'm doing. If I allow everybody to be writing, we won't leave this question today. So you write later.
Please, sir, so just to confirm, right?
Yeah.
For like I observed that for some little calculations, like how you got the income tax and the rest, we don't need to show workings in a separate place for that.
No, those ones are very direct. No need. No
Okay,
need.
sir.
Yeah. So let's determine sales for 2009. In 2009, how many units were sold? In 2009, 180,000 units were sold. Therefore, I would then say 180 multiplied by 10.5. Selling price is 10 naira 50 kobo. So this gave us 1890. Here is 1890. That's the sales value for 2009. So I will then go to production cost in 2009. The closing stock in 2008 of 496.4 will become opening stock in 2009. So let me shift this one to the front. 1890. Okay. Thought I have okay, yeah. Okay then. Now in 2009, our opening stock will then be 496. Here is 496.4. Then direct material. In 2009, how many units were produced? The company produced 150,000 units. So I would then say 150 multiplied by direct material cost per unit, which is 1.6, multiplied by 1.6 equal 240. Here is 240. Again, direct labor cost will then be 150 multiplied by 1.5 equal 225. Variable manufacturing overhead. So 150,000 units multiplied by 1.2 equal 180. Fixed manufacturing overhead. 150,000 units multiplied by 3 naira equal 450. You notice that the fixed manufacturing overhead is changing as the activity level changes. So that is why I said that under absorption costing method, the fixed production overhead will vary according to activity level because it's based on the activity level. So let's add up all the numbers. So 450 plus 180 plus 225 plus 240.
1591.4.
91.4. Okay, 1591. 1591.4. Thank you. Then closing stock. So let's go and determine our closing stock in 2009.
Hello, sir.
Yes.
It is 1592. 1592.4. Confirm.
Me, I got 1591. Let me do it again. 450 plus 180 plus 225 plus 240 plus 496.4. I got 159.4.
1591.4.
So you can check the calculator again. Okay, then. So let's go and value the closing stock in 2009. So we have done the workings before. In 2009, closing stock for ACM, 2009 closing stock in unit is 38,000. So I would then call me 38,000 units multiplied by 7 naira, 30 kobo.
Okay.
So what do we have there? So
77.4.
277, right?
0.4.
Okay, 0.4. Yeah. So here is 277.4. Thank you. Let's quickly do for the variable costing. 38,000 units multiplied by 4.30 equal 38,000 multiplied by 4.3.
163.4.
163.4. Thank you. So 277.4 is what we... I didn't get that. Where did I get 4.3?
Yes, sir.
Is in the question. The total cost per unit is 7 naira 30 kobo when you less the fixed manufacturing overhead. So all you are going to have left is total variable cost per unit. Yeah. 277.4. 277.4. So closing stock is 277.4. So what's the difference?
1314.
1314. So we need to consider over assumption. Remember in our calculation earlier, we got 150,000 as our over assumption. So we need to add it to the cost of goods sold. Here it is. This is the 150,000 here. So let's go and adjust. Let's add it to the cost of goods sold. So here is 150. So 150 plus 1314.
1464.
Okay. 1464. 1464 minus 1890.
426.
426.
426. Okay, then. So they represent the gross profit in 2009. So we need to consider non-production costs. In 2009, how many units were sold? 180,000 units were sold. Therefore, the variable selling and admin expenses is 50 kobo. Therefore, 0.5 multiplied by 180 will give us 90,000. Okay. The fixed selling and admin is constant at 75,000. So here would be 75. So when you add the two together, that's 165,000. 165,000 minus 426. What do you get?
261.
261,000. So 261 multiplied by income tax of 40%.
104.4.
Thank you. Minus 261. What do you get?
156.6.
156.6, right?
155.6. 155.6.
156.6.
156.6.
Okay. Thank you. So this represents the net profits for 2009. So we have completed absorption costing method. So let's go to variable costing method according to the question. So let me know if you have any question for me here before we proceed to that.
I have a question, sir.
Talk to me.
Concerning the sales, how do you get the 1,896?
How do we get what?
The sales price for 1,896?
You multiply the units sold with the selling
Because
price
I've been
per
finding it
unit.
difficult on how you get it.
You multiply the
Yes,
units
sir.
sold with the selling price per unit.
Okay, sir. Thank
The selling, for example, in 2008, units sold in 2008 was 160,000. Selling price is 10 naira 50 kobo. When you multiply, you will get 1,680,000. Is it clear now? Try it in your calculator. Yep. Okay. So,
Hello, sir. In our calculation under the valuation,
yeah.
in our variable cost, where we had a 4.3, where do we get it from?
Somebody just asked the question and I explained. You are still asking me again.
Yes, I didn't get you.
The total cost per unit is 7 naira 30 kobo in the question. Total variable cost per unit is direct material of 1 naira 6 kobo, direct labor of 1 naira 5 kobo, 50 kobo, then variable overhead of 1 naira 20 kobo. When you add the two of them together, that will give you 4.3. Okay? Is it clear now?
Okay, thank you. Yes, thank you.
You're welcome. So let's move to variable costing method. Let's go to variable costing method. Okay. Number B, income statements. Using variable costing method. Our figures are in thousands, 1,000 naira. So 2008, then 2009. So the first item here is the sales value. The sales value you have under absorption costing method will be the same thing as variable costing method. So here is 1,680. Then this one is 1,890. Okay. Now we need to consider production costs. We can say variable production costs. Now, the first item is our opening stock. So remember, under marginal costing approach, stocks are valued at total variable cost per unit. And total variable cost per unit in this question is 4 naira 30 kobo. That is 1.6 plus 1.5 plus 1.2. When you add it together, that's 4.3, 4 naira 30 kobo. So in 2008, opening stock is 28,000 units. Therefore, 28,000 multiplied by 4.3, that gave us 120.4. Here is 120.4. Let me write this so that to be clearer. At 4 naira 30 kobo. So 120.4. The next item will be my direct material cost. So direct material. So the direct material cost will be the same thing as under absorption because it's the same activity level that is driving it. So direct material cost under absorption is 320. So I would then come a 320. I also have direct labor. Direct labor is, I think 240. Let me see. Yes, 240. Direct labor is 300. 300 and 240. 300. Then we also have variable manufacturing overhead, which is 240. Remember, one of the principles that we discussed today is that under marginal costing method, fixed production overhead is not part of production cost. Rather, it should be written off fully from the aggregate contribution. So when you want to determine the production cost using variable costing method, you don't include fixed production overhead. So at this point, I will then add up everything together. So 120.4 plus 620 plus 240. 980.4. Here is 980.4. This is the COGAS, cost of goods available for sales. After this, we need to less closing stock. Thank God we have done working for our closing stock. That's working number 1. Okay. So let's go back and pick the number we have there for closing stock under variable costing method. In 2008, variable costing method, closing stock is 292.4. 292.4. So here is 292.4 minus 980.4 minus 980.4. What do we have there? Minus,
688.
pardon?
688.
688. Thank you. 688. So this 688 is called cost of goods sold. Okay. Immediately after the cost of goods sold, under marginal costing approach, there are some costs that are variable but not related to production. Therefore, you need to add variable non-production costs. Add variable non-production cost. This is where you can have variable selling and distribution expenses, variable admin expenses. Any cost that is variable but not related to production must be added to the cost of goods sold. So in this case, in the question we have variable selling, we have selling and admin expenses. Selling and admin. So we've determined it before under the absorption, which is 80,000. Variable selling is 80,000 that we have here under admin, under absorption. Okay, so let's consider that 80,000. So I will then add 80,000 to this. So there is no other variable cost again in the question that is not related to production. So just add these two together. That's 768. So 768 minus the sales value. 768 minus 1680. What do we get? 1680 minus
912.
That's 912. 912 represents the contribution. 912. Let me rewrite this. 768. So this 912 is called contribution. Okay. Immediately after contribution, you must consider period cost. Remember the definition of absorption, the definition of a marginal costing approach. We said that marginal costing approach is an accounting system whereby the period cost incurred or the fixed cost incurred are written off fully from the aggregate contribution. This is the contribution that you have here, 912. So at this point, you need to less the period cost. So any cost that is fixed in nature, so you deduct it from the contribution. So we have fixed manufacturing overhead. Remember what I explained to you last time. We said that as far as marginal costing approach is concerned, fixed costs are costs that have no sympathy for activity level, which means that irrespective of number of units produced, the fixed cost will not change. So it will remain constant because fixed cost is based on the budgeted output. So in this case, the budgeted output is 200,000 units, and the fixed overhead absorption rate is 3 naira. Therefore, 3 naira multiplied by 200,000 budgeted units will give us 600,000. So I will then come here. Here is 600,000. I will go back to the question, what are the other fixed costs that have been incurred? We also have fixed selling and admin. Selling and admin to be 75,000. When you add the two together, that's 675. So 675 minus 912. 675, that's 237. 237. This 237 is called profits before tax. So you need to less income tax at 40%. So what's 40% of 237? Multiply
94.8.
94.8. Here is 94.8. So what's the difference? Net profits. What's the difference? Minus
142.2.
142.2. 142.2. Thank you. So this represents the net profit for 2008. So quickly, let's go to 2009. So in 2009, opening stock in 2000 and closing stock in 2008 of 292.4 will become opening stock in 2009. So here is 292.4. Okay. Then direct material cost in 2009. Let's repeat what we have in under absorption, which is 240, 225. Here is 240. 225. Then what else? 180. 180. Let's add everything together. What you get? Let's do it together. 292.4 plus 4.
937.4.
937.4. 937.4. Okay. 937.4. So let's go and pick our closing stock. Okay. We've done the working previously. And we got 120 something. Okay, we got 163. We got 163. Yeah, 163.4. 163.4. Here is 163.4. So what's the difference?
774.
774. 774. So let's add variable non-production costs. So selling and admin expenses in 2009 was 90,000. Here it is. This is the 90,000 here. So let's go and add that. Variable selling and admin in 2009, 90,000. So here is 90,000. 90,000 plus 774. That's 864. So 864 minus 1890. What do you have? 864 minus
1026.
1026.
all right, thank you. 1026. Here is 1026. Okay, so that's represent contribution for 2009. So you need to consider period cost. Remember what I told you under marginal costing approach. Fixed costs are costs that have no sympathy for activity level, meaning irrespective of number of units produced, fixed cost does not change because it is based on the budgeted output. So the budgeted output is 200,000 units. Fixed cost per unit or fixed overhead absorption rate is 3 naira. 3 multiplied by 200, that's what gave us this 600. So that 600 will remain constant. Okay, it will not change. That's why we say it has no sympathy for activity level. So this guy is also 75. So add the two together, 675. 675 minus 1026. What do you get?
351.
351. 351 multiplied by 0.40. 40%. What do you get?
1404. 140.4.
0.4. Okay. What's the difference now? That's 210.6. Am I correct?
Yeah.
Okay then. So we have calculated, we've just completed income statements using absorption costing method and then variable costing method. So let's go to the C part where examiner has you to do reconciliation statement so that can allow you to write. Yes, somebody is talking. Talk to me. Are you talking to me? No. Okay, let's move on. So quickly, let's do the reconciliation statement. Number C. Reconciliation. So under the reconciliation statement, you are supposed to compare difference in profits and difference in stock valuation. If the difference in stock valuation is the same thing as difference in stock, difference in stock in profits is the same thing as difference in stock valuation, it means what you have done is perfectly okay. So here I will say 2008, then 2009. So I can come here, naira in thousand, naira in thousand. If I don't want to do this, I can put my naira on top. So here I have profit before tax. Please, when you want to determine your reconciliation statement, you don't use net profits. You don't find difference in net profit. It has to be difference in profit before tax. So I will pick the absorption costing method. I will also pick the profit before tax for variable costing method. Based on our calculation, in 2008, the profit before tax under variable costing method is 357. In 2009, profit before tax under absorption costing method is 261. So 357, 261. 357, here is 357, then 261. Under variable costing method, profit before tax, 2008, 237, then 351. 237, 251. Okay, so let's find the difference. Okay, here should be 120. Okay.
90.
90.
Minus 90.
Is it 251 or 351? Let me see. 351. This one is 351. So that will be minus 90. Okay, so this represents difference. Let me write that. Let me shorten it. Difference in profits. Number A. Then let's go and do difference in stock valuation. Stock valuation. Remember, the major difference, the main reason that is causing conflict between the two techniques is the method of valuing stocks. So when I want to determine my stock difference in stock valuation, I will start from closing stock. So under the closing stock, I will pick absorption costing method. I will also pick variable costing method. So under absorption costing method, what is the closing stock? I think this one is closer. Yes, 496.4. So here is 496.4. So I will come here, 496.4. For VCM, I think it's 277.4. Let me confirm. No, 292.4 in 2008. Closing stock is 292.4. So what's the hiatus? What's the difference?
204, 204.
204 is the difference. So let's go to closing stock in 2009. What do we have there? 277.4, then 163.4. 277.4, then what do we say is the other one?
163.
163.4. Thank you.
That's 114.
Okay, 163.4 minus, that's you said 114, right?
Yes, sir.
114. So this represents difference in closing stock, but there's no need for you to put difference in closing stock. Just go and do opening stock. Opening stock. Under opening stock, we have ACM, absorption costing, and then variable costing method. So for the opening stock, from our table above, now closing stock in 2008.
2044.
Opening stock, you say is what? 204.
2.4.
Then for variable costing method, what's the opening stock?
120.4.
120.4. What's the difference? That's 84, right? Is it 84? Okay. So 84 minus
84,
204.
sir.
Okay, 84 minus 204. That should give us 120.
Yes.
So this represents difference. Difference in stock.
120.
Okay, so that's difference in stock. So let's go to 2009. In 2009, the closing stock in 2008 will become opening stock, which here will be 496.4. Here will be 292.4. So what do you have as the difference? What's the difference?
204.
204. So 204, 114 minus 204, what do you get? That should give us minus 90, right?
Yeah.
Yes, sir. Minus 90.
Okay, then.
Jacket 9.
Okay, so this is B. You will notice that our A is equal to B. Difference in profits in 2008 was 120. Difference in stock valuation in 2008 was 120 also. In 2009, it's minus negative 90, then negative 90.
20
so,
plus 120.
So that's it. So that's end of it. So which means that what we have done is perfectly okay. So at this point, I can then listen to your question. before we pick another illustration. So some people have sent me a chart. Please, we don't have the material, or we've gone past that one. Please, I don't have the material. We've already passed that one. Can someone share? I believe someone has shared. Tife also asked, how did we get the 80,000 for the selling and admin? Tife, have you gotten, do you understand now how we got the 80,000?
Yes, sir.
Aha. Then 0.5 says, okay, somebody was trying to explain that. Okay, that's that.
A quick question. I think I missed something. This last one, that valuation that we're doing.
Is that Joy?
Yes, that's
Okay. Talk to me.
yes. So the opening stock, this stock valuation, that's the reconciliation statement.
Yes.
I know for the assumption we put 496.4. Okay, I've looked at my book very well. I think I've seen the 292.4. I was looking for it before.
Oh, okay then. All right. Good.
Hello, sir.
Yes, talk to me.
Good evening, sir. Thank you for the effort.
You're
I
welcome.
think I think I have an observation.
Talk to me.
Okay. The old material that we have, the handout rather,
Yeah.
is it still valid for this November diet?
It's still valid, but again, it has been updated. So forget about the old material now. Let's focus on this one. But it's still valid if you have it.
Okay, can we get it? Can we get the updated one? Is it available?
We have shared it. That's what we are using now. It's not.
That is
We don't have
when
the
you
printed.
share.
We don't have the printed copy again.
Okay,
Yeah.
that's it. Thank you.
You're welcome. Okay.
Hello, sir.
Yes, talk to me. Who is speaking?
Under Amara.
Oh,
Under this
Amarachi.
period cost, yes, under the period cost, we have the fixed overhead. That's 600.
Okay, yes.
How do we get it?
How do we get the 600? Okay, let me just write it down so that it will be clearer. Okay. Under the variable costing method, let's make this one working number 3. It's very important that you understand the concepts. Working number 3 are fixed manufacturing overhead under the variable costing method. So this is my explanation. As far as marginal costing method is concerned, fixed cost or fixed production overhead is a cost that have no sympathy for activity level, meaning that irrespective of number of units produced, the fixed cost will not change, the fixed production overhead will not change, because the fixed production overhead is based on the budgeted output or the normal capacity. So it is not based on actual production. So in this case, if I want to determine my fixed manufacturing overhead or my fixed production overhead, so the fixed manufacturing overhead supposed to be calculated, if not given to me in Naira, supposed to be calculated as the budgeted output multiplied by the fixed overhead absorption rates. So in this question, budgeted output, the number of units, the normal capacity is 200,000 units. So you multiply it with the fixed overhead absorption rate, which is 3 Naira as given to us. Therefore, the fixed manufacturing overhead is 600,000. Is it clear now? Joy? Joy?
Yes,
Yes,
it's clear,
sir.
sir. Amara.
Oh, sorry, Amara. Okay then. So let's go back. Okay, let me go and indicate that in the solution. Working number 3. So here is working number 3, so that you know how we derive the 600,000. Okay, then. Okay. So,
Hello,
yes,
sir.
yes, talk to me, Yusuf.
Good evening, sir.
Good evening.
Please, I want to ask, what kind of decisions do companies use these techniques to make?
It's causing what?
What kind of decisions do companies use this technique to make?
It's for management accounting, and when you talk about like I said, even from the definition, we said that operating statements is a statement that is used to present the operating performance of an organization. Just like you have profit or loss accounts, which is a measure of performance for an organization. And when you talk about performance, what we simply means is net profit or loss. So it's a statement that is used to present that income, or that is used to present that net profit. Net profit is the result of an organization or performance. Okay, so we use it. It's just a deviation from the normal POA, profit or loss account, for management reporting purposes. Okay, under performance management, you use this statement to present the operating performance. Is it clear?
Yes, sir. Thank you, sir.
You're welcome. So let's have one more illustration so that we can call it a day. I will stop sharing this and move to the next one.
I will finish that, yeah.
We should be able to. We should be able to.
Okay, sir. Not to take much of your time. Can we just snap it?
No worry, I will share this template with you. I mean, this solution that we have, I will share with you the PDF.
All right. All
Yeah.
right. Thank you.
You're welcome. So let's move I will stop sharing this. Let's go to the final question. Where is that again? Yeah. Let me know if you can see my screen, please.
Yeah.
Okay, then.
Yes, sir.
Yes, I need somebody to read for us.
Panama Limited
Okay, thank you.
makes and sells one product which has the following standard production cost. Direct labor, 3 hours at 6 naira per hour, 18 naira. Direct material, 4 kilograms at 7 naira per kilogram, 28 naira.
Move to the next paragraph.
Okay, normal output is 16,000 units per annum. Variable selling, distribution, and administration costs are 20% of sales value. Fixed selling, distribution, and administration costs are 180,000 per annum. There are no units in finished goods inventory on 1st October 2021. The fixed overhead expenditure is spread evenly throughout the year. The selling price per unit is 140 naira. Production and sales budget are shown in the table below. Required. Prepare operating statements for each of the 6 monthly periods using marginal costing technique and assumption costing technique.
Thank you very much, Tife. So that is that. In this question, examiner wants you to prepare the operating statements for each of the 6 monthly period using marginal costing technique and then assumption costing technique. You see, this question looks very straightforward and simple, but it could be dicey if you don't pay particular attention to the dictate of the question. You will notice that the period ending in this question is 6 months. So what that means is that any cost that is given, especially the fixed cost that is given for 1 year, which means you have to divide it by 2 to make 6 months each. So if you don't pay attention, you may be doing the wrong thing, thinking that you are doing the right thing. And that's why it's important for you to understand the basics. I mean, the information that is given in the question. You should be able to interpret it appropriately. You don't rush, because as you're rushing, you won't know that you are doing the wrong thing. And it's important for you to articulate your point before you put your pen to paper. So without wasting more time, open to the question at your own hand. Let me switch to the working notes so that within the next 30 minutes, we can, let's say we complete this. Okay. I believe you can see now. All right, then. Let me scroll down. Yep. Illustration number 2. The name of the company is Panama Limited. Number A, you are required to prepare income statements, operating statements using a marginal costing technique. So I would then say income statements using marginal costing technique. Our figures are in thousand. So we have period ending March 2015. Let me confirm. So 2022, March 2022, and then September 2022. So here is March 2022, September 2022. Okay. Then the first item should be my sales. Pay attention. So let's go back to the question together. How many units were sold for the period ending March? So sales
7,000.
7,000 units. So what's the selling price per unit? The selling price per unit is 140 naira. Therefore, 140 multiplied by 7,000 multiplied by 140. That's 980. 980. Thank you. So here is 980 dash. I will then say production cost. Remember, we are using marginal costing technique. So here is opening stock. Now, for the period that ended in March, this period of 6 months would have started in October, 1st of October. So let's go back to the question. If you are given opening stock for March, is there any opening stock? There is no opening stock. We are not given any opening stock, so you put a dash. We are not given opening stock, so you put a dash. Then the next item will be to determine the direct material cost. I will go back to the question, am I given direct material? So we have direct material of 28 naira per unit. Okay. We also have direct labor. Let's start with direct labor as given in the question. So I will then say direct labor. How much is direct labor per unit? 18 naira. At 18 naira. Direct material at 38 naira. What other variable costs do we have there? We also have variable production overhead, which is 3 naira. Variable production overhead.
Sorry, sir. Direct material is not 28.
Direct material, let me confirm again. So direct material is 28. Thank you. You would have made a mistake and be coming back again to looking for balancing figure. That's good. Okay then. So in March 2022, how many units were produced? So
8,000.
8,500 were produced in March. 8,500 were produced. Therefore, I would then say 18 naira multiplied by 85, which is equal to
153,000.
153,000. Here is 153. Again, for direct material cost, 28 multiplied by 85. What do you get?
238.
238. Next, 85 multiplied by 3. What do you get?
25.5.
25.5. Thank you. Because we are using a marginal costing technique, you don't consider fixed production overhead. Therefore, you add up this. We don't have direct expenses in this question, so we ignore. So add it up. What do you have here, please?
416.5.
416.5. This represents the cost of goods available for sales. So we less closing stock. The closing stock will be valued at total variable cost per unit. How much is our total variable cost per unit? 18 naira plus 28 naira, that's 46. 46 plus 3 naira, that's 49 naira. So let's go and do our working. So marginal will be here, absorption will be here, reconciliation statement will be here, then our working will follow. Working number 1, closing stock. March. Then September. Opening stock. In March, opening stock is nil. We don't have opening stock. Then you are going to add actual production. Actual output. In 2002 March, production is 8,500 plus 0, 8,500. This is total units available. From this, you are supposed to less units sold. Units sold. How many units were sold in March?
7,000.
7,000. So
1,500.
this is 1,500. This is called closing stock, closing or unsold stock. Let's do for September. The closing stock in March will become on the 1st of April. The period that ended in September would have started in April 1st. So April to September is 6 months. So opening stock in September will be 1,500. In September, how many units were produced? 7,000.
8,000.
7,000. 7,000, that's 8,500. How many units were sold? 8,000. So minus that will give us 500. So the closing stock in September is 500. Therefore, I need to determine the valuation. For March, valuation for the period ending March 2022 under marginal costing technique, then absorption costing technique. For the marginal, the closing stock in units, 1,500 units multiplied by, what's the total variable cost per unit? 49 naira. You add up 18 plus 28 plus, what's the next one? I think is 4, no, 18 plus 28 plus 3, that's 49. Yep, that's that. So what do you have here?
73,500.
73,500. So this is 73.5. Figures are in thousands. Then under absorption, 1,500 units multiplied by, what's total cost per unit? 69 naira. 69. So multiply with 1,500. What do you get?
103.5.
103.5. Okay, that's that. So let's go and post. For March, closing stock in March is 73.5. 73.5. So closing stock, working number 1. 73.5. When you minus, what do you get? 416 minus 73.5.
343.
343.5.
343. So this represents the cost of goods sold. Immediately after the cost of goods sold, you must consider you must add variable non-production cost. Okay, let's go and check from the question if you have variable selling. So according to the question, the paragraph after the table, after the first table, you are told that variable selling, distribution, and admin costs are 20% of sales value. Variable selling, distribution, and admin are 20% of sales value. Therefore, I would then say add variable non-production cost.
196.
So we have variable, I'm coming, variable selling, distribution, and admin at 20%. Because you can see, examiner said at 20% of sales value. So what's our sales value in March? Our sales value is 980. Okay, sales value is 980. So what's 20% of 980?
196.
196.
196. 196. So 196 plus 343, what do you get?
590.
539.
539. So minus 980.
441.
441.
441. This 441 is called contribution. Immediately after the contribution, you have to less the period cost. So I would then say period cost. Under the period cost, I will go to the question if I'm given fixed production overhead. We have it there, which is 20 naira per unit. The fixed overhead absorption rate is 20 naira. So I would then say fixed production overhead. Let me shorten that because of space. Now, let's go and do working for this. Remember what I told you, under marginal costing approach, your fixed production overhead is based on the budgeted output. It's not based on actual, so it's based on budgeted output, meaning that you have to multiply with the budgeted output. You multiply the fixed overhead absorption rates with the budgeted output. So I will also do for September in this one. For March, I will do for, what am I saying? For September, yeah. Under September, I have MCT, then ACT. Bele. Okay. Now we'll come back to that one later. But first thing first, working number 2. Let's determine the fixed production overhead. Okay. So like I said, the fixed production overhead is based on the budgeted output under marginal costing approach. So I will then go back to the question, what is my budgeted output? After the first table, the next paragraph says that normal output is 16,000 units per annum. I repeat, normal output is 16,000 units per annum. If you use the entire 16,000 units to calculate your fixed production overhead for the month of March, for the period ending March, then that means you are going to get it wrong. The first thing you need to do is to divide the 6,000 units by 2, because that 16,000 units is for 1 year, and the period ending is in March and September. So you need to divide this 6,000 by 6 months. That is 6 over 12. That's 8,000 units. Therefore, I will then come here. My fixed production overhead, let me just help you further. Since the normal output of 16,000 units is for 1 year. Is for 1 year. This should be divided by 2 to account for the units attributable to period ending March and September. Okay, as shown below. So this is one of the things that examiner has hidden in the question, because if a student is not careful, if you are too eager to solve, oh, this question is very simple, straightforward. So if you don't pay particular attention to those little things, you can't get it right. So that's why you don't rush. When you see a small question, you have to think twice before you put your pen to paper. Otherwise, you will think you are doing the right thing. Okay, then. So for the period ending March, I would then say 16,000 units divide by 2 or multiply by 6/12, whichever way you want to do it. Divide by 2 or multiply by 6/12 is the same thing. Okay. All of this multiplied by the fixed overhead assumption rate of 20 naira. So what do you get? 8,000 multiplied by 20.
160,000.
160,000. So here is 160,000. You do the same thing for September. It should be the same amounts. For the month of September, 16,000 units multiplied by 6 months each, multiplied by 20 naira. What's wrong with you now? Time is not connecting. Sorry, let me stop sharing and share again. My pen is not connecting.
18 minutes more.
No, that's no problem. We finish it. Let me just stop sharing this and reshare again. Okay. Excuse me. Let me quickly reshare. Okay. Coming up. Yes, it's not working. It's back. Let me share again. Yes. So multiply by 20. So that's 160,000. So we now have the the fixed production overhead, which is 160,000 for the period ending March. So let's go and post. So here is working number 2. What's wrong with you again now? Mr. Abdulatif, you are the one causing diesel. My pen is
What
not.
is that?
My pen is not connecting. I'm writing
That's
message.
almost time out. That's because
It's not.
less than 18 minutes more.
That's not the issue. It's your spirit that is making it not to because you want me to. Your spirit, no worry. It will work. It will work. Control S.
It will work, sir.
Of course, it has to. It has to. Let me go back.
They play.
It will work. If you're up to 1,000, it will not. Tonight we are going to complete the question. It will work.
No.
Oh yeah. So this is working number. Irọ́ ló ń pa, ó máa ṣiṣẹ́.
It's your demonic laugh. Please stop it.
Don't worry. This question you must complete it within the next 5-10 minutes. Let me change my battery. Don't worry.
I just wish that you check your time as you struggle with it.
No, no worry. Let me check. Let me try and see. Okay. Yeah. Just 1 minute. Close.
Work again. Give it to us as assignments. Probably like
No worry. I will give you another. So certainly you have your own assignments. I will surely give you assignments.
Exactly. Abi.
But for now, I must finish this particular question.
I just like your spirit, sir. Continue.
Okay.
it was also past question. Do this Latif.
No
Those
worry.
are past.
Don't worry. I know how to deal with him. No. This is working. Can you see? This is working number 2.
Oh, I'm not seeing. You can't see your screen. No.
Oh, you are not seeing. Oh, that means I'm not sharing. Let me go back. Oh, I'm not sharing.
You can see it. You can see your screen.
No.
See your screen.
I'm
It's
not
gone.
saying.
Don't worry, you see it. I shared the wrong one.
Everywhere is
Sha,
dark.
there's one network issue there, Sha.
No,
You
it's
can
not.
see, sir.
It's not a network issue. So our fixed production overhead based on our working is 160,000. Okay.
Yes, sir.
So immediately after this, we need to go back to the question if there are other fixed costs. Certainly, we're also told that we have fixed selling, distribution, and admin, which is 180,000 naira per annum. Okay. So again, let's go and make adjustment for that. Fixed manufacturing, fixed selling and distribution expenses. This is working number 3.
Fixed selling, distribution, and admin.
Fixed selling, distribution, and admin. Okay. So for the month of March, for the period ending March, it is calculated as 180,000 naira multiplied by 6/12, which is equal to 90,000. You see the way we are making the adjustment. We can't use the entire 180. That 180,000 is meant for 1 year. And we are calculating for period ending March and then period ending September. So you have to divide it by 6 months. 6 divided by 12 months. So that will give us the appropriate numbers that we're looking for. Okay? So that's that, 90,000. Then in September also equal to 180,000 naira multiplied by 6/12, or you can just say multiply by 50%, which is the same thing as 90,000. So let's go and post up there. 90,000.
Excuse me, sir. Since it's the same thing, is it necessary we show for the first and the second month?
It's just our working. It's just the working. So it's not the main solution. You can choose to not to even write it down. You can choose to just type it on your calculator and post. So, but it's important to write it down so that you don't make mistake. Even when you make mistake, you can easily trace it where the mistake is coming from. So here is fixed selling, distribution, and admin, working number 3, which is 90,000. So add the two together, that's 250. 250 minus 441, what do you get?
191.
91.
19.
This 191 is called profit before tax. Let's go to the question. Are you given income tax?
No, we're not
So,
given.
so there is no income tax. So if there is no income tax, this profit before tax will represent the same thing as net profit. Let me write that. So I can say profits before tax / net profits. So I'm done for March. Let's go to September quickly. In September, how many units were sold in September? 8,000. 8,000 multiplied by 140. What do
10
you get?
minutes more.
1120.
1120. 1120. Then opening stock. The closing stock in March of 73.5 will become opening stock. Here is 73.5. Direct labor. How many units were produced in September? 7,000 units were produced. So 7,000 multiplied by 18. 7,000 multiplied by 18 equal 126. Here is 126. Next one. The next one is 7,000 multiplied by, what do you have there? 28. Multiplied by 28.
196,000.
196. Next, 7,000 multiplied by 3.
21. 21.
21. Here is 196, then 21. Add it up. What do you have? 416.5.
Yes.
416.5 is just a coincidence for the cogas to be equal. So closing stock in September, I think we have calculated that. Closing stock in September.
No, I've not.
We have not. Okay, let's quickly do it. Yes. The closing stock in units in September was 500 units multiplied by 49 naira. Okay. What do you have? 500 multiplied by 49.
24,500. 24.5.
24.5. Then under ACT, 500 units multiplied by 69. What do you have?
34.5.
34.5.
0.5.
Okay, so we have 24.5. Closing stock 24.5. Okay, closing stock here is 24.5. What's the difference?
392.
392. So we need to, what's 20% of sales? 20% of 1120. 20% of 1120.
224,000.
224.
Yes.
224. Okay, 224 plus 392. That's 616. 616 minus 1120.
504.
Pardon?
504.
504. That represents the contribution. The fixed production overhead will remain the same thing as 160. We have done the calculation down there. Then fixed selling, distribution, and admin is the same thing as 90. It will not change. So add it up. That's 250. So 250 minus 504. That's 254. Okay. So that is for that. Let's move for Assumption.
250 minus.
Yes, 250 minus 504. What do you get?
Yes.
Is 254 wrong?
Okay.
It's correct.
No, sir, it's not wrong.
Number B, income statement using absorption costing technique. Figures in thousands. March, September. Sales is 980 here. Here is 1120. Production cost. Opening stock. Opening stock dash. Then we have direct labor. Direct labor we got 153. Direct labor is 153. It's not going to change. We also have direct material, which is how much? 238. Here is 238. We have variable production overhead. Based on our calculation previously is 25.3. 25.3. Then we have fixed production overhead because we are using absorption. So fixed production overhead is part of production cost. And the fixed production overhead is at 20 naira. In March, how many units were produced? In March, how many units were produced?
500.
8,500. Therefore, 8,500 multiplied by 20, what do you get?
170.
170. Okay. So here is 170. Add it up. 170 plus 25.5 plus 238 plus
5.
3. You say it's what? 586?
6.5.
6.5. So this is Cogas. It less the closing stock. We've already done working for our closing stock. So I'll go and pick the number. Closing stock in March, ACT is 103.5. 103.5. Here is 103.5. What's the difference?
483.
483. 483. This represents cost of goods sold. Immediately after the cost of goods sold, we consider overhead absorption. So let's go and work it out. Overhead absorption. That's working number 4. Working number 4. Overhead absorption. So we have period ending March, then September. So budgeted output for the whole year in 2022, budgeted output is 16,000. 16,000 divided by 2, that's 8,000. Then 8,000. Actual output.
4,250.
No. How many units were produced in March? 85.
8,500.
85. Then in September, 7,000 units were produced. So let's find the difference. So here is the difference. Here is
minus
500. Then here is 1,000. So let's value it. So yeah, let's value it. Valuation. For March. March is under equal to under. which is equal to 500 units.
Jacket 500.
Yeah. Okay. To be consistent, then multiply by what's the fixed overhead absorption rate? 20 naira. Your fixed production overhead per unit is your fixed overhead absorption rate, which is 20 naira. Multiply by 500 will give us minus 10,000, right?
Yes.
Then for September, the difference in September is 1,000 units, which is over. So that's 1,000 units.
Nice.
Multiply by 20 naira. So what do you have? That's 20,000 naira. Okay. So in March, we have under. Then in September, we have over. So let's go and do that. 10,000, 20,000. Yes. We have under, over. Absorption. Let me shorten that to put the work in there. This is working number 4. So here in September, in March, we have under of 10,000. So minus 10. Okay.
473.
That's what? 473. Okay, here is 473. 473 minus the 6. 6 of 980. What do you get?
507.
507. Okay, so this represents gross profits.
No, 473 minus
Minus
what?
980.
I don't get
980 minus 980. Okay, so then you now add non-production, sorry, you less non-production costs. Non-production costs. According to the question, we have variable selling, distribution, and admin, which is we've calculated before, which is 20% of the sales.
Yeah.
Variable selling, distribution, and admin are 20% of sales. And we got what did we get before?
Yeah.
196. We got
Sales for
196. Yeah. We got 196. Here is 196. Then what other fixed costs, what other costs do we have there? We also have fixed selling, distribution, and admin, which is 90,000. Fixed selling, distribution, and admin, 90. Add it up. This is 286. 286 minus 507. What do you get?
286, sir.
Yes, minus 507.
221.
Here is 221. So this is the profit before tax or net profit for period of March. So as we are going to September, opening stock. So we have closing stock in March of 103. Here is 103.5. Let me write that to make it clearer. Then direct labor, we have calculated before. How much was that? 126, then 196. 126, 196. Variable production overhead. What do we have there? Variable production overhead was 21. Here is 21. Then 20 multiply. How many units were produced in September? In September, we produced, where is that again? We produced 7,000. So 7,000 multiplied by 20.
14.
Pardon?
140.
140. So here is 140. Add it up. What do you get? 103.5.
585.5.
586.5, right? 586.5. Then closing stock. We've calculated closing stock. Let's go and check.
Hello, sir.
Yes, 34.5.
Please confirm that figure.
Okay, 34.5. Here is 34.5. Yes, 103.5
I've confirmed.
is correct, right? 586.5.
Yeah.
Okay. Minus 34.5. Minus 34.5.
552.
552. Okay. Then we have over absorption. Over absorption of I think it's 140 something. How much is over?
20.
20.
20. Let me confirm. Yes, 20. Thank you. So 20 is the over absorption.
That's 572.
20, that's 572. 572 minus 1120. Yeah,
548.
548. Okay. So non-production cost. Yes, in September, the non-production cost, variable selling expense was 224. Okay, 224. Here is 224 plus 90. That's 314. 314 minus 548. What do you get?
234.
234. That represents the profit before tax or net profit. So at this point, even the examiner did not ask you to do reconciliation statement to be sure that what you have done is correct. So you need to prepare your reconciliation statements. Let me call this one C. Reconciliation statements. So March, September. So profit before tax. ACT, MCT, MCT. So what's profit before tax under ACT? Profit before tax for ACT, we got 221, 234. Here is 221. Here is 234. Then under MCT,
191, 254.
191, 191, 254. Okay. So here is
30.
30. Then here is minus 20. So this is difference in profits. Number A. Then you now go to difference in stock valuation. Stock valuation. So closing stock, ACT, MCT. So closing stock for ACT, what do we get?
103.5.
103.5.
And 34.5.
Thank you. 103.5 and 34.5. What's the hiatus? What's the difference?
No. 34 for the second year. The two marginal.
Oh,
two
okay.
absorption.
Oh, okay. 34.5. Let me remove this. Then for MCT,
73.5.
73.5. So what's the difference?
103.5 minus 73.5.
That's 30, right?
59.5.
So MCT in September, what do you have as closing stock?
34.5 and
4.5.
24.5.
24.5, difference of 10. Okay,
10 years.
so we have difference in the opening stock now. So let's do opening stock. Under opening stock, we have ACT, then MCT. So opening stock for March,
New.
nil. Okay, this is dash. This is also dash, right?
Mm.
Then
103.5.
103.5, which is what?
For the second year, marginal absorption.
For absorption. In September.
Yes.
So here, hold on first. This one is dash. So dash minus 30 will give us 30. So this is difference in stock. The next one. So opening stock in September will be the closing stock in in March, which is 103.5. Then here will be 73.5. What's the difference? 30. Okay, 30. So 10 minus 30, that's minus 20. You see? So the difference A must be equal to B. All right? So that's that. Let me know if you have any question for me. Like I said, immediately after this class, I will share the document with you so that you can have access to it. Yes, let me know if you have any question for me.
Please, why is this opening stock?
Yeah.
Why is it in minus? Why is it 30,000 in minus, in negative?
30,000. We don't have opening stock in March, so that's why it's dash. When you look at the solution we have up here, look at, you see, opening stock here. What do you have there? Nil, nothing.
Yeah.
So that's why you put dash.
I'm talking about the one for September. I said, why is it in negative?
September is not. Why is it negative?
Yes. So
See, hold on. When you say 10 minus, see, look at this one is positive. This one is negative. If you say 10 minus 30, what would it give you? Is it not negative?
Yes, I mean, when we are deducting 103.5 minus 70.5, why are we having 30 in brackets?
You are lessening it. You are lessening difference in opening stock from the difference in closing stock. So you are lessening this from this.
I get that part though. I'm saying, so now for absorption costing technique, we have 103.5.
Yes.
For marginal costing technique, we have 73.5. 103.5 is higher than 73.5. But when we were putting our answer, we put it in
You are lessening it. You are lessening it from 10. You want to less something from 10. You are lessening this.
Taking closing minus opening. Yeah.
See, look at, it's the same thing you did there now, is it not? It's the same thing that you did there. 34 minus 24.5, you got 10. 103.5 minus 73.5, you got 30. It's the same thing there. So the difference between 103.5 minus 73.5, which is 30, you are lessening it from 10. Okay? Is it clear to you?
So I think what she's driving at is the ACT there is 103.5, which is positive. And it is higher than the MCT, which is 73, negative 73.5.
It is 30. It is still the see. Look at this.
Plus 30.
Hold
but
on.
you minus that 30 later.
So this This 30.
Oh, yeah, it's 30. Yeah, it's 30. The 30 is not negative, it's positive.
Yes. So this
And
30,
then
you
the
have to less
30
from
is,
10.
yeah. It's taken out of 10, and then that's why.
Yeah, the 30 must
Okay,
be deducted from.
understandable. Yeah.
Is it clear now?
Yes, it is.
Okay. All right then. So any other
Hello, sir.
question? Yes, talk to me.
In this kind of question where we have both marginal and absorption costing technique,
Yes.
can the question go further and ask us to choose advise the company on which one to use?
You don't advise, so there's nothing like advice in this one. All you need to do is just prepare your income statement. No advice. Just like you do your normal POL, profit or loss accounts. Just prepare your income statements. So you may have the note to the accounts to explain the line items, but as far as this one is concerned, just prepare your income statements. That's all. Okay.
All right, sir.
Yeah. Yes. Any other question?
Hello, sir.
Yes, talk to me. Yes, talk to me. Who's speaking?
Sorry, sir. There might not be question now, but in case we are trying to solve it by ourselves and we have, so how can we reach you to?
You have my number. We are in the same group, so I'm reachable. The bottom line that's what I advised you. Was it last week or thereabouts or earlier today? So your starting point is for you to memorize the formats. Understand the concepts in each of marginal and absorption, then you memorize the formats. Study the formats as you have it in the material or in the notes that I gave to you last week. Close your book, write it on your own in your own working note, then begin to solve the question the way we have solved it. Even if you don't get it, if you have mistake, one or two mistakes, go back to the solution and correct yourself. But if you have any question, always reach out to me privately. All right?
Yes, sir.
Okay, then. Yes, any other questions so that we can close the class for today? All right, then. So in the absence of no further question, thank you guys for your time and understanding. I will see you again by the grace of God next week, Monday. However, Mr. Shuaju will be available on Wednesday to take you. All right, thank you guys. Good night.
Thank you, sir. Don't forget to share the notes.
No, I will
Thank
not.
you, sir. Good night, sir.
Good night.
Thank you,
Thank
sir.
you. Good
Good
night.
night. Good night.
Good night, everyone.
Yeah.
Good night. And the homework, sir.
No worries. I will send to
A
you.
practice. Okay.
Yep.
Don't kill yourself.
Yeah.
Go practice that one first.
All right then.